I often say opportunity zones may be the greatest tax incentive ever created, but opportunity zone investing can be challenging even for the most seasoned investors and advisors. That's why I created today's event. Welcome to OZ Pitch Day Summer 2023. I'm Jimmy Atkinson, founder of OpportunityDB and WealthChannel. I'm going to be your host for today's live online event. Now, OZ Pitch Day is geared toward helping you as an investor get more comfortable with opportunity zone investing. We've done 8 of these already. This is our 9th, and ultimately, we want to help you make an investment into one or more qualified opportunity funds, investments that have the potential to help you grow your wealth while also driving private capital into some of our nation's communities that are most in need. So opportunity zones investing, this is a 101 crash course for high net worth investors. Legal disclaimer before we dive in, of course, this is not legal advice or investment advice. Please consult a professional advisor before making any investment decisions. Of course, very serious legal disclaimer. And now a silly meme to transition us into the presentation today. And I'm going to explain to you why so many investors, once they catch sight of opportunity zones, are ready to dump capital gains taxes for good. Here's a schedule of what we're going to be covering during today's presentation. By the way, we are going to share this deck with you. If you stick to the end, I'll show you where you can download this deck. I'm going to go through the deck quickly. I'm going to skip over some parts because we only have a limited amount of time before our next presentation. But I believe opportunity zones are the greatest tax incentive ever created. We're going to cover who can invest, why the policy exists in the first place, the policy background, which is kind of helpful to know from an investor's point of view. We're going to go over facts and figures, some terminology, and then the meat of the discussion is going to center around the tax benefits themselves, how to qualify for those tax benefits, and how to ultimately achieve unlimited tax-free growth. We'll also discuss some similarities and differences between opportunity zones and 1031 exchanges and DSTs. And then I'll touch on some updates that the program has undergone over the past few years, marketplace updates, and some legislative and regulatory updates as well. And then I'll end this presentation with a little how-to on how to invest into qualified opportunity funds, how to make an investment into opportunity zones. And that'll be a nice segue into the rest of the OZ Pitch Day event, where you'll hear from a lot of qualified opportunity funds that are raising capital. First of all, who can invest in opportunity zones? Anyone can invest, but in order to take full advantage of all the tax benefits, you have to be a US taxpayer with capital gains. And typically you need to have capital gains of at least $50,000, both to make it worthwhile for you to jump through some of the hoops. And also, practically speaking, that's the bare minimum amount that a lot of funds have established. Other funds have higher minimums, maybe 100,000 or 250,000. This means that this program is almost exclusively limited to accredited investors. In fact, the vast majority of qualified opportunity funds are only open and accepting capital from accredited investors, which are essentially high net worth individuals, the ultra wealthy, and family offices. You need to have patient capital. OZ investing, in order to take full advantage of all the tax benefits, does require a 10-year holding period. And you'll also need some liquidity in 2027 for a deferred tax liability. I'm going to get to that a little bit later in the presentation. I'll let you know what that is all about. But to start, I want to go through very quickly the policy and the policy thesis that was developed post-recession. Coming out of the Great Recession of 08 and 09, some policymakers were looking around the country and they realized that wealthy areas, wealthy zip codes recovered from the recession very quickly and very well. Low income areas got left behind. Income inequality and wealth inequality, that gap widened. And at the end of 2017, right as this legislation was getting passed, it was estimated that approximately $6.1 trillion of unrealized capital gains was sitting on the sideline or sitting on the books of individual investors and corporations. So the policy challenge was, how can we unlock that capital and incentivize wealthy individuals and corporations to invest some of their wealth into these low-income areas to stimulate the economy? So that's the problem, that's the challenge that policymakers were facing in the 2010s as we were coming out of the Great Recession and as wealth inequality was widening. The bipartisan place-based policy solution that policymakers came up with was opportunity zones. So the goal of opportunity zones, the policy goal, is to produce economic revitalization and to stimulate the local economies in low-income communities. In order to do that, they have to provide an incentive to investors, and the incentive is enormous. I think, again, the greatest tax incentive ever created. capital gains tax deferral, and unlimited tax-free growth. Here's a timeline. I'm not going to go over every single point in here, but I just want to point out that oftentimes this program gets labeled as a Trump-era program, but its roots date back to when President Obama was in the White House. The concept was first developed in a think tank in Washington, D.C. called the Economic Innovation Group in 2015. It eventually got passed as part of Trump's Tax Cuts and Jobs Act. We've had a couple of points in time where some of the benefits have already expired, but the biggest benefits are still available as of right now. This is a perishable tax incentive, as I stated earlier. It's set to sunset after 2026. If you get capital in before then, your investments aren't going to sunset. There's just not going to be new opportunity zone investments after 2026 unless Congress can extend the program. Again, I'm going to share this deck with everybody, so no need to read through all of that right now. Let's go over some basics now with Opportunity Zone, some Opportunity Zone facts and figures. This is a bipartisan piece of legislation. It has broad bipartisan support. It had broad bipartisan support when it was first introduced into Congress in 2017, and it continues to receive broad bipartisan support all over the country. It is a perishable tax incentive. Some of the benefits have already expired, some of the minor benefits, and then the main benefit will expire after 26, like I mentioned. It's a place-based policy and investment program, and as a result, there are over 8,700 census tracts that have been designated as qualified opportunity zones as of the middle of 2018, exactly 5 years ago this month, actually. 35 million people, 35 million Americans live in these census tracts that are designated as opportunity zones. And these opportunity zones cover roughly 12% of the land mass of the United States. The Treasury Department originally estimated that this would be a $100 billion economic development program. And I'm happy to say that we've already surpassed that number and then some. I think it's going to shatter even Treasury's optimistic expectations, and it's going to end up being the greatest economic development program in US history. Here's a map where all of the opportunity zones are located throughout the country. There are the blue shaded areas there. Opportunity zones are in every state. They're in Puerto Rico, they're in Washington, D.C. They're even in Alaska and Hawaii. My apologies to them. They didn't make the cut on the map here, but all of those blue shaded areas are opportunity zones. There are opportunity zones in rural areas, in metro areas, and in suburban areas. In every area you can consider, there are opportunity zones in primary markets, secondary markets, tertiary markets. They're all over the map. Let's go over some technical terminology before I get into the main tax benefits. I'm going to get there very shortly. A QOZ or an OZ is an opportunity zone. It is the actual designated census tract. It's the geographic area that is on the map. It's those blue shaded regions on the map. That term oftentimes gets conflated with the second term on this list, which is the Qualified Opportunity Fund, or a QOF or an OZ fund. That's the investment vehicle through which all qualifying investments have to be made. And then the QOF holds assets that are located in opportunity zones. And those assets can be any of that alphabet soup of letters on bullet points 3, 4, and 5 there. Qualified opportunity zone property, business, or business property, also known as the alphabet soup there. Section 1400Z refers to the Internal Revenue Code section that codified opportunity zones as a result of the Tax Cuts and Jobs Act of 2017. So that's a little refresher course for some terms that you'll need to know. Now let's get into the fun part here. I think it's the fun part, the tax benefits. I think it's why we're all here today. The deferral and unlimited tax-free growth that opportunity zone investing offers to investors. And it starts with a capital gain. That's one thing you need to be aware of from the get-go. This is a program that is designed to incentivize capital gain dollars to flow into these opportunity zone communities all over the country. Any investor who has a capital gain, and it can be from the sale of anything, stocks, cryptocurrency, collectibles, investment property, real estate, privately held business, any sort of capital gain, if that investor rolls over that gain into a qualified opportunity fund within 180 days, that investor is eligible for the following benefits. You can see I have benefit number 2 crossed out. That one has since sunsetted as of the end of 2021, but it might come back at some point if some legislation gets passed. And so that's why I keep it in this presentation here. So there's 2 main benefits that are available right now. Again, the second benefit might come back, might not, but benefit number 1 and 3 still make up a pretty compelling case. Benefit number 1 is a gain deferral period. You get to defer recognition of your initial gain that you roll over into an opportunity zone fund until the end of 2026. So you don't have to pay the tax liability on that initial gain until April of 2027 is when that tax bill comes due. Benefit number 2, there was a period in time where you can get that initial gain amount reduced by either 10% or 15%. That benefit since expired. It was a nice cherry on top type of benefit, but it didn't really move the needle too much. Benefit number 3 is the big one, gain elimination. If you hold your qualified opportunity fund investment for at least 10 years, you pay 0 tax on any subsequent gains within that opportunity zone once you exit. So I'm going to walk you through an example now, put some numbers to this. Let's assume a taxpayer has a fairly substantial gain, $10 million capital gain. Maybe this taxpayer sold some low basis Tesla stock or Facebook stock, or maybe he or she sold a privately held business. It doesn't matter. We'll assume a 23.8% federal capital gains tax rate for maybe a stock market investor or a privately held business sale. Also, just want to note, this is a very simple, simplistic, overly simplified example. I'm going to walk you through. I'm missing some nuance here and there. We're going to ignore state taxes, but just to keep it simple and to cover the high level points, here's how I'm going to walk you through this. Now, normally, that individual would have a $2.3 million tax liability due the following April, leaving that individual with $7.62 million net to invest or to do whatever with. Instead, let's say this person rolls over that gain amount, that full $10 million gain amount, into a qualified opportunity fund. By the way, unlike a 1031 exchange or a DST, you'll note that the principal amount, the basis amount in that investment, whatever it was, maybe it was $1 million that grew to 11, leaving the $10 million gain, let's say, that $1 million basis or principal amount does not need to be rolled over. That can just be completely taken off the sidelines or invested elsewhere. Let's walk through the benefits now. The first benefit is a deferral. So essentially you get to defer recognition of that gain, of that $10 million gain, until the end of 2026. It essentially amounts to an interest-free loan from Uncle Sam for a few years. So you get the benefits of the time value of money. You get a greater amount of compounding because instead of having just 7.62 million net to invest, you suddenly have $10 million to invest. Now, important, the tax on that gain does eventually come due in 2027, and this benefit does become less valuable with each passing year. It was much more valuable 5 years ago. Now, the deferral period is really only a few years left, but it's still quite valuable. One risk that investors face is that the 2026 tax rate is going to apply, and tax rates could rise, but I think that can be to your benefit in the long run, as we'll see in benefit number 3. Now, the reduction benefit did get nixed after some of these benefits perished. This benefit officially expired after December of 2021, or did it? Because it's possible that some legislation may reopen that window again, but for now, that benefit doesn't exist. This is the big one, the gain elimination benefit. Again, you pay 0 tax. So let's say your $10 million QOF investment in opportunity zones appreciates to $25 million after 10 years. You sell, you've got a $15 million gain. Normally, you'd have a pretty hefty tax bill, a 7-figure tax bill on that $15 million gain amount. Here, you pay nothing, absolutely nothing. And one important note is that the gain must be recognized by the end of 2047. That's written into the IRS regulations. So you can't just hold it forever, unfortunately. And you can appreciate, I hope, that if the tax rate goes up over the next few years, over the next 10 years or so, this benefit becomes more and more valuable. Oh yeah, by the way, a bonus benefit. This is particularly interesting for real estate development or real estate investors who take depreciation there's no depreciation recapture on the back end once you sell out of your property or that fund. Normally, depreciation recapture would eat into your return significantly. There's zero depreciation recapture as long as you structure the depreciation within a qualified opportunity fund. A huge, huge benefit. I'm not going to go over what depreciation recapture is. I don't have time, but hopefully, if you're a real estate investor, you know how valuable that is. This is a great chart I love, and my friend Jill Homan, I don't know if she's in the audience today, but hi, Jill, if you're out there, maybe you're watching now or we're watching the recording. Jill from Javelin 19 Investments provided this chart to me a year or two ago, and I've been using it in these presentations ever since. You can see the after-tax IRR and multiple on a qualified opportunity fund investment, which are those blue bars, versus a taxable investment, which are the red bars. You can see how much of an impact these OZ benefits have on returns. A 12% pre-tax IRR equates to an 8.2% after-tax IRR, given some assumptions in the fine print there. And the multiple gets reduced from 2.68 to below 2x if you're comparing a similar qualified opportunity fund with a taxable investment, all else being equal. Oftentimes, opportunity zones get compared to another type of capital gains deferral program called the 1031 exchange, or the passive version of a 1031 exchange, which is a Delaware statutory trust investment, or DST. This is a pretty in-depth table. I'm going to kind of gloss over it, but just to point out a couple of things here. In order to achieve the full tax benefit for a 1031 investor, the full benefit doesn't kick in until you die, and then it passes on to your heirs that step up to fair market value for your heirs upon your death. You can continually keep deferring the tax forever, but it doesn't step up to fair market value until you die. The step up to fair market value happens for an opportunity zone investment once you hit a 10-year holding period, or once you sell after you hit a 10-year holding period, I should say. So you can get the full benefit after just 10 years with an OZ investment. The capital gain eligibility piece is important. If you have a real estate gain, you have options here. Gain from real estate, you can do either an OZ investment or a 1031 exchange. If you have a gain that's non-real estate, if it's from your stock portfolio, if you sell your business, if you sell some cryptocurrency, if you sell your art collection, your comic book collection, whatever it might be, a 1031 or a DST is not available to you. It has to be a like-kind exchange. So you're really left with just an opportunity zone investment, which is a great outlet because no program like this existed for those types of non-real estate gains until just the last 5 years. Let's go to the investment strategy and risk, because this is a really important piece as well. Opportunity zones, it should be stated importantly that they are riskier types of ventures. They are ground up construction, they are substantial redevelopment, or they're startup businesses. By very nature of the definition of the statute and the regulations, I'll get to why in a moment here. But suffice it to say, opportunity zone investments are capital appreciation plays, and you're going to take on a little bit more risk, but also a little bit more reward on the back end potentially. Whereas DSTs, you're investing for capital preservation and stable cash flow. For a typical 1031 exchange, there's some variability there, but it doesn't necessarily have to take on the same amount of risk as a ground up construction deal would when you're making an opportunity zone investment. And then I'll just skip down to the geographic restriction. Of course, there is no geographic restriction for 1031s and DSTs, but with opportunity zone investments, one thing to consider, you are limited to those 8,700 plus census tracts, most of which are deemed as low income. Go through a marketplace update and a legislative update quickly. We have invested well over, not we, me personally, but the country has invested well over $100 billion into these opportunity zone communities so far to date. And as of the end of 2020, which is the year for which data is most recently available, nearly half of all opportunity zones have received some equity investment, reaching approximately 3,800 communities all over the country. I touched on the fact that there's some legislation floating around out there that might extend opportunity zones beyond that 2026 end date, and that might also reopen some of those basis step-up reduction windows. The Opportunity Zones Transparency, Extension, and Improvement Act was introduced into Congress last year. Unfortunately, it did not pass, and in fact, no tax legislation passed, but Congress does have some numerous tax legislation programs that they need to extend or reform. And the OZ industry is hopeful that this legislation that would make opportunity zones permanent, or at least extend it by a few years, could get reintroduced and passed either this year or next year before this session of Congress expires. So fingers crossed there. Let's briefly touch upon what a qualified opportunity fund is. Again, that's the vehicle through which all opportunity zone investments must be made in order to qualify for all the tax benefits I just outlined. This is a new vehicle that was established just in 2017 as part of the OZ legislation. And according to the IRS, QOFs have to comply with a number of requirements in order to adhere to the policy intent of the program. Remember, the intention of opportunity zones is not simply to incentivize an investor to come in and invest in a stabilized cash flowing property, or to have an investor come in and do some light value add work to a property and raise the rents. They want to create substantial economic revitalization in these neighborhoods. So as a result, they require either a new building be put into use, ground up construction typically, or there's substantial improvement of dilapidated buildings. We'll have examples of both throughout the course of the day today. There's also a 90% asset test, meaning that at least 90% of all the assets held by a qualified opportunity fund have to be physically located in an opportunity zone. By the way, there's many other requirements. Those are the top two, I think. So as an investor, you really have two options to invest into a qualified opportunity fund. You can be active and create your own captive QOF, or you can be passive and invest as a limited partner into a private placement offering that's structured as a QOF. With a captive QOF, you're self-funding your own fund. You can actively invest in your own project or alongside other QOFs. There is a little bit more of a burden placed on you. You have to file a couple of forms with the IRS every year, but it's fairly straightforward to get started as a QOF. The devil's in the details when it comes to compliance. Investing as an LP in other third-party QOFs is kind of the point of OZ Pitch Day today. We're going to be showing you a lot of those QOFs that are accepting capital from limited partners. It's similar to investing in a private equity fund. There's a variety of flavors, so you need to consider your investment objectives. And it's somewhat similar to investing in stocks, right? There's different types of stocks, there's different types of ETFs, there's different types of mutual funds. Same goes for QOFs. There's all sorts of different ways to invest in qualified opportunity funds, whether it's a single asset deal or a national multi-asset class pipeline across the country, or maybe a tightly geographic focused area. They're all over the place. So it depends on your investment objectives. A typical fee structure, this is just an example, a 1% to 2% asset management fee is not uncommon, and then a pref hurdle of 8 to 10%, and then a 20% carried interest. Investors just need to file Form 8997 annually with their tax return to comply with the investment program and to make sure that they continue to receive all the benefits. Some questions you should consider asking before investing as an LP. I'm going to skip through this slide because we're running a little short on time. But again, you're going to be able to get this deck downloaded here. So how do you invest? Well, today we're going to showcase 10 different qualified opportunity funds for you. That's not the whole universe of funds, but these are 10 solid options for you to consider. So make sure you ask questions today in the live Q&A and participate in the chat. We're gonna send some bonus material on the next slide. I would encourage you to download those bonus materials and read up on them. Please use today's presenters' time effectively and have follow-up conversations with them. Take advantage of the time you have today to schedule follow-up calls. And then when you're ready to invest, request subscription documents from these different fund managers. Here's the free bonus that I promised everybody who attended today. You can scan that QR code with your phone, or you can download now by heading to OpportunityDB.com/bonuses. When you head to that webpage, you're going to get two guides, actually. You're going to get the how to make your first opportunity zone investment guide. And I also have put a PDF version of this deck available for download up there as well. So head to opportunitydb.com/bonuses